What's up, guys? My name is Mark Edler. I'm the founder of Edler Zane, and we're a CPA firm for entrepreneurs. And today I'm going to walk you through the exact steps that you need to buy your first business. I've helped over 100 entrepreneurs buy businesses in the last 2.5 years, and I've also bought 2 CPA firms myself. If you follow these exact steps, you'll have a much higher likelihood of buying a business successfully that will actually work for you. The first step is industry selection. I talk to a lot of searchers who say that they're industry agnostic. This is the #1 red flag for searchers. When you buy a business, you're buying a piece of the market that business operates in. There's a couple different industries that work pretty well for searchers from what I've seen, but it also depends completely on your personal skill set and background. Here's a few that I've seen work most frequently. The first is home services. So think about plumbing, HVAC, landscaping. These are all businesses that are needed nationwide and have tons of customers because everyone with a house can use these services. The other good thing about these businesses is that they live in fragmented markets because it requires a local operator to physically operate the business. This means it's much harder for someone in the state next to you to compete with you. So that local fragmentation creates an opportunity for a small business owner. The other good thing about these businesses is that they're mostly recurring revenue. So you have people that need maintenance on their home either every month or at least on an ongoing basis every few months or every year or so. The last thing that makes these attractive is that there's also private equity firms frequently buying these. And so once you scale the business up to a certain size, you can get a pretty good exit by selling to a larger landscaping company or selling to a private equity firm. And once you do sell, you can sell at a better multiple than what you bought for, assuming that you scaled it up. The next area that generally works well is professional services. So think about CPA, bookkeeping firms, IT consultancies, and other consulting firms. These work well because they're also recurring revenue. And a lot of times the background of searchers is something in finance, banking, or another professional service. So you'll generally understand how the business model works. The other nice thing is that you're managing white collar employees as opposed to blue collar, which tends to be the background of searchers, which makes it a lot easier for you to operate. These are also businesses that tend to be tech enabled. And what that means is basically you can implement automation software and really add some value to the business that the owner had not have previously done. The next one is commercial services. This is pretty similar to home services, but it's just done for a business instead of an individual. The last one is manufacturing. Manufacturing is an interesting one because it does have inventory and products involved, but it also has a lot of automation opportunities and it can become a scalable business, and especially for someone with a manufacturing background. The example I most frequently see searchers lose, even if they close, is retail. Retail is an extremely difficult business model because of the inventory management that's required and the location dependence. So if you think about how a typical retail store works, you're very connected to the physical location that you're in. And if that's in a bad location, then it becomes really difficult to enhance the profitability of the business. The other thing is that the landlord has a ton of leverage over your business. I've seen a bunch of acquisitions where everything goes well in diligence, and then you get to the end and you're negotiating the lease with the landlord as a part of the purchase. And the landlord is stubborn or doesn't want to transfer the lease to a new owner, and it just completely blows up the deal. So you have to be aware of this before you go into diligence on a retail acquisition. That being said, I have seen retail businesses that work, and a lot of times the most successful business owners that buy retail businesses are also buying the real estate. If you do decide to go the retail route, I recommend finding something with a long operating history and proof that the community really likes that location. The next tough one is construction. Construction has a similar business model and labor base to home services, but the issue is that the projects are very logistically complex. So it's a really bad place to be in as a first-time operator to have so many different areas where something could go wrong in the business in the first 100 days and cause you to lose. The other issue is that there's a lot of people involved in the construction process. So other subcontractors, general contractors, the builder, local townships, governments, and it can only take one of these people not agreeing on the project plan or how things were done to hold up the execution of your project. And that usually means that you can't get paid either. So it's a very complex area to be in from a cash flow perspective, which is not where you want to be as a first-time operator with monthly debt payments to the bank. The next one is e-commerce. So similar to retail, you're selling a product to a customer, but you're doing it online. And you might think that, oh, this is so much better than retail because you can sell to anybody and you're not location dependent. But the new problem is that you're competing with just about everybody. This usually means that if you have a good product that people want, there's a bunch of other competitors, and it's typically a race to the bottom on price, which means that you're going to have a hard time managing margins for that business. It also means that you probably are going to continually have to create or find new products to sell, which just makes inventory management that much more complex. The last one that I definitely don't recommend buying is restaurants. So you'll see a lot of restaurants for sale on business is buy sell. Usually they're not doing that much in terms of profitability. And these are incredibly high risk, low reward businesses that are not only not very profitable most of the time, but also extremely stressful. So I definitely don't recommend buying restaurants. And the only exception would be if you're looking at a franchise opportunity where maybe there's multiple units. That shows that the business has real maturity and a process that you can follow, but definitely don't look at your local restaurant. It's just very difficult. The next piece of identifying a good business is looking at the earnings of the business. The first thing you want to understand about the company's earnings is the actual amount of earnings that they're doing. There's a lot of argument in the acquisition community about whether it makes more sense to buy small or buy big. Generally, I don't recommend buying anything under 500,000 in adjusted earnings. And when I say earnings, I mean EBITDA, which is really earnings before interest, taxes, depreciation, and amortization. If you're buying a business that's below 500K in EBITDA, you're basically buying a job. There's also a much higher risk that if things go wrong in the business, it's just going to fall apart completely. Or if it doesn't fall apart, it'll be because you're forced to jump into the weeds of the business immediately, and it's going to cause you a ton of stress and pain. So I generally recommend looking for a business that's at least 500K in earnings. The other reason to not buy small is that you could just as easily learn about the industry for a couple of years and either, work in another business that's similar, or even work with a coach or a mentor that's in the space and just go start that business from scratch. And you'll be able to do that. It'll take more time, but you won't have the debt and the risk of failure. Now, one thing to understand when you're looking at the earnings, you have to understand the total EBITDA, but also the EBITDA margins of the business. The sweet spot for a healthy business is somewhere between 15 and 20%. And that's generally the national average for a small business. If you're lower than 15%, that usually means that the industry is very competitive or the business is just not being run very efficiently. And even though you might think that there's upside there, it's very difficult to expand the margins as a first-time operator, especially when you're investing in new things like technology and more headcount. Your margins are actually usually going to go down after you purchase a business as opposed to up. So definitely look for any business that is above 15%. Now, the other flip side is there's a risk in buying a business that has over 20% margins as well. And that might sound counterintuitive, but the reason is that a business that does over 20% in margins usually has a lot of owner dependence, which can mean that there's risk once you step in and replace the owner. And it can also mean that the business is very niche, which, sounds really nice, but it probably also means that it might not be very scalable. And if you're looking to buy a business to grow it, then you're just going to have a hard time achieving that growth. So if you do the math on that, if you're looking at 500K minimum in earnings and 15 to 20% margins, you're probably looking at a business that's at least 2.5 to 3.5 million in total enterprise value, which is higher than a lot of businesses that you'll see for sale online. So next we'll talk about how to actually look for these deals and what to look for once you start talking to the seller. The first thing to look at when you're sourcing a deal is where you're sourcing it from. So there's a lot of conversations in the acquisition community about whether it makes more sense to go through a broker or to go proprietary. And a lot of people say that it makes more sense to go proprietary because, you don't have as many competitors and you don't have to deal with the broker. And brokers get a pretty bad rap, and sometimes they earn it. But you also have to consider that a broker in your first transaction can be your best friend. So that person is basically training the seller on what to expect during the deal. And it also confirms that that seller is actually interested in selling their business. Whereas if you go proprietary, you could go months, trying to teach the seller, what specifically the terms and expectations are, and they could just pull out at any given time because they haven't really mentally committed to selling the business. After you start at sourcing deals through various brokers or other online sites, the next thing that you're gonna have to do is evaluate the seller. So when you get on an intro call, it's important to build rapport, obviously to improve your likelihood of being able to get an offer accepted, but you're also evaluating that person and understanding whether they've built a business that's going to make sense for you. The first thing that I want to know is why they're selling the business. Generally, I'm looking for businesses that are either a retiring owner and, confirming that their retirement age, or has some type of health issue or, a real personal reason that they can't operate the business anymore. Because these are the most typical reasons that someone has to step out of the business. You don't want to buy from someone who is younger and has only owned the business for a couple of years, because it usually means that the reason they're selling is that there's something wrong with the business. Once you've determined that, the reason the seller is selling is legitimate and you feel comfortable about the information that the broker's given you on that business, the next thing you want to do is look for context and clues outside of what's been provided. So there's a bunch of different things you can do once you started talking to the seller and the broker and gotten the name of the business. I like to look at customer reviews. I look at social media profile of the owner. You can look at employee reviews on Glassdoor or other sites. You can even look up the employees. And I would also recommend looking at their LinkedIn. So you're trying to get a sense for what is the composition of the team, what's the structure of the team, and how long have the employees been with the company. If you have constant turnover and there's no employee loyalty, there's a pretty good chance that there's a reason for that. And most of the time, it's because the seller is not an easy person to work for and has built some type of negative culture in the business. All right, so once you've gotten through your search, you figured out what industry you want to acquire in, you understand the criteria that you're going to look for in a deal, you understand how to vet a seller. The next part of the process is going to be actually making an offer, which is called an LOI or a letter of intent, and then going through the due diligence process after that. The first piece is the offer. The most important part of the offer is the actual price that you're willing to pay for the business. We talked about earnings earlier. Your offer is going to be based on those earnings. So typically what I see in the small business M&A market is something from 3.5 to 5 times earnings. And usually you're looking at the prior year or an average of the last couple of years. And ideally you'd like to peg this to a more recent value. So if you can get trailing 12-month financials, that's actually the most reliable and useful earnings number that you want to use. But sometimes it's hard to get that before an LOI. So you can base your offer on what you've seen thus far. And I actually recommend that you use a multiple of earnings in your LOI, because if you find that earnings go down, it's a lot more easy to explain to the seller why you might have to retrade your offer. Whereas if you're just going to use a flat number and say that, you want to purchase this business for 3 million, then the valuation loses clarity and it's a more difficult retrading process. The next part of your offer is the financing. So obviously you could buy the business fully with cash and bank financing, but I generally recommend that you also use either a seller note or an earnout. And the reason for that is that it provides more protection for you in the deal. In addition to being a financing source for the acquisition, you also are leaving the seller with a certain amount to receive after closing, which means that your success is tied to their success. If you do a deal without an earnout or a seller note, there's just a higher risk that the seller can step away. They have no reason to support you after closing. And if you're working with someone who has low integrity, it means that they could basically just walk away and you're stuck completely with the business and have to learn how to fix it. There's a few other key terms that you want to include in your offer. So big things to think about are transition terms. Usually you want at least 6 months and maybe up to a year to work with the seller and make sure that they properly transition the business to you, because most small businesses rely a lot on the owner. And the next thing is a non-compete. You might think that because the owner is retiring or gave some reason that they're selling the business. I've heard plenty of times where the seller will sell you the business and then you find out, 6 months later, a year later, that they're back out there doing landscaping or accounting or whatever it was. And they may even start competing with you and marketing to your previous clients. So the non-compete is a very relevant part of your offer. And the market usually says that about 5 years is an ideal length for a non-compete. And if your seller tries to negotiate below that, you have to ask, why do they care, right? And that could be almost an instant reason to just drop out of the deal. Anything longer than 5 years is probably not necessary and sometimes might not even be legally enforceable. So I generally recommend that you stick to about 5 years and obviously consult with a lawyer. Once you have your offer accepted, the next step is to get a quality of earnings done on the business. And this is the key financial diligence tool that you want to use to confirm that the earnings that you've seen thus far are actually what the broker said they are. We also offer this service at Edler Zane. So if you're interested in getting a QOV done, definitely feel free to use the link below and reach out. We can have a call. Now there's 2 steps that go into a quality of earnings, and there's a bunch of things that happen in each of those steps, but you should have it broken down into these 2 milestones. So number 1 is going to be the verification process of the financials. So this is where we're actually looking at the financial statements. We're pulling the reports from the accounting system and we're reconciling those against real data sources that we can validate, like bank statements, tax returns, payroll documents. We're getting receipts for add backs. And we're basically saying that with the financials that have been provided, we can see that there's real data that supports that the business has done this level of earnings historically. And we're also looking not only at the last couple of years, but also the trailing 12 months, like I said, so that you understand that the near-term performance is equally as good as the prior year performance and that you're not buying a falling knife. Once those financials have been validated, the next part is to analyze the financials. So this is where we're looking for financial risks that, could put you in a bad position, even if the earnings are what they said they were. Think about things like customer concentration, even supplier concentration, changes in margins, pricing pressure, could be inconsistency in cash flow from working capital issues, a various, amount of different underlying trends that you want to watch out for so that you're prepared after closing, not just to, know that the earnings are right, but that you know how to manage this business financially and can look out for any high risk areas. The other thing that should be done in the quality of earnings is normalizing for certain revenues and costs. So if there are one-time items that were not identified previously, those need to be adjusted out of the recast financials. And you should also look for things that are not included in the financials, like missing costs. It could be employee positions that need to be filled. It could be critical software that needs to be installed in the business, or other things that are industry dependent where the operator previously found a way to run the business without it, but you're going to need it. The last piece of the quality of earnings is going to be a net working capital analysis. And what that means is we're looking at the assets and liabilities within the business that are readily convertible into cash. So think about accounts receivable, inventory, payables. These are things that should be transferred with the business. And so you have to understand what level of working capital the business has historically had and how much you should receive as the buyer at closing. Now, if your deal is below a certain size, you may not have working capital included, but you should still understand what it was historically so that you can work to get that amount financed through your bank and bring enough cash to the deal where you're not going to run out of cash in the first 100 days. Once you've done this quality of earnings and feel comfortable that the financials are real and that there's no other significant risks, the next thing you should do is build a financial model. So you're looking at forecasting cash flows into the future based on the pro forma financials and also layering in any other costs that you might add to the business. And then looking at your financing sources and what your projected, debt service or equity investor payments may be, and making sure that you can actually cover cash flow for, the first 12 months and then also the, several years beyond that. So this is going to tell you a rough indication of whether it's a deal that's going to work or not. All right. So if you've gotten through finding a business and making an offer and doing your due diligence, you've almost gotten there, but there's one last piece to closing a deal that's going to work for you. The last part is structuring and financing. After you've gone through diligence, you probably found things that you didn't know before you made the LOI because you only have a very short time frame to actually understand the business and make an offer before the LOI. Now is the time to take that information that you found and potentially reconstruct your offer. So obviously you don't want to make too many significant changes to the terms because you don't want to freak out the seller and you want to be an honest, reputable buyer, but you want to change the terms based on things that you found that were not disclosed previously. I definitely don't recommend retrading on things that you already knew because it just ruins your reputation as a buyer. And if you're going to be a repeat buyer, it's going to become much more difficult because word spreads faster than you'd expect in small business acquisitions. Now, keep in mind, a lot of people think that equality of earnings is for retrading on price, but a retrade can happen on a couple different factors. So when you're making an offer, we talked about price, we talked about seller financing and other key terms. Any one of those terms could be retraded during the post-diligence final offer process. So if there are specific risks around customer concentration or other things related to revenue that concern you, it could be that you want to change the price, but most sellers are going to be pretty hung up on the price that was offered. So a lot of times it can make more sense that you actually rework the terms. So what I've seen work a lot, and I've actually done this myself, is rather than changing the price, you change the amount of seller financing that's involved in the deal, and you can use that seller note as a retention mechanism for revenue in the future. On the deals that I've done to acquire accounting firms, we know that customer concentration or the relationship being transferred from one accountant to another can be complex. So we use revenue retention agreements with our seller notes in all of our deals. So once you've kind of figured out what terms you're going to retrade on and what your final offer is, this is the information that's going to go into the purchase agreement, which will either be an asset purchase agreement or a stock purchase agreement. And this is going to be what you actually legally sign when you close on the business. The next step is going to be financing. So you should have already started the financing process in terms of, interviewing banks, potentially getting a high level introduction to investors that you might use. But this is the time where now that you actually have the deal lined up, you're confident that it's going to close, it's time to finalize your financing. So if you don't have it already, you should have a term sheet from a bank. And this basically tells you how much they're willing to finance in the deal and what the interest rate and other terms will be. And then you also want to finalize your terms with investors. So there's a variety of things that can go into an equity investor deal, but the main things are going to be, whether it's common or preferred stock that they're buying, how much they're actually going to finance on your behalf, what the preferred rate of return is, and any other key terms like equity step-ups or other terms that we'll talk about in the future. These should also go into the financial model that you build. So these terms are very important and set the stage for your success moving forward for the next several years. So hope this was helpful. If you're working on a deal and you need help with quality of earnings or deal structuring advice, feel free to click the link below and book a call. Happy to chat.